They called him a Wall Street wizard, a financial maestro capable of conjuring profits out of thin air. Celebrities loved him, corporations trusted him, and even charitable foundations put all their faith and fortunes in his hands. But behind the curtain, the wizard was simply pulling off the largest Ponzi scheme in history.
Is a for-profit enterprise. By benefiting one person, you're disadvantaging another person.
One that reached a staggering $65 billion on paper. Welcome to a tale of deception, greed, and financial illusions so massive that they shook the foundations of Wall Street itself.
The Dow down nearly 450 points.
We just hit 730 or something. We've never seen that.
Buckle up. This is the story of Bernie Madoff and the multi-decade fraud that fooled everyone from movie stars to financial regulators. Disclaimer: this video is for informational and entertainment purposes only, drawing from publicly accessible sources. Always do your own research and consult professionals when it comes to financial matters. Chapter 1: The Great Facade. In the cozy circles of Manhattan's elite, Bernie Madoff was nothing short of a legend. He'd been chairman of the Nasdaq Stock Exchange twice. He came across as charitable, warm, and almost fatherly to many. If Madoff liked you enough to take you on as an investor, you felt like you'd won a golden ticket to endless returns. But there was something far more potent behind that Midas touch. Madoff had built a towering facade of credibility, anchored by his high-profile titles and an air of exclusivity. The impression was that if you were lucky enough to get in, you'd never doubt his financial genius. Combined with years of social proof, philanthropic projects, industry connections, and a family-centric business, he seemed above suspicion, and few dared to question his uncanny consistency. Chapter 2: How a Ponzi Scheme Really Works. We've all heard the term Ponzi scheme, but the Madoff version was in a league of its own. He promised modest yet steady returns, around 10% annually, and claimed to use a unique strategy called split strike conversion. In reality, he was simply paying older investors with funds collected from newer investors, shuffling money in a giant shell game. No real trading happened, despite the detailed statements he'd send out each month. Those statements were fabrications, reverse engineered to match whatever returns he decided to report. The secret to the scheme's longevity was the sheer consistency of those gains. Markets could crash or rally, but Bernie's fund never seemed to lose. That level of stability might sound comforting, yet real investments never move in a straight line. The steady, upward-only results helped convince thousands, from high-net-worth individuals to international charities, that they had found the holy grail of finance. Chapter 3: The Whistleblowers and the Red Flags. The irony here is that people did suspect something was off. The most famous skeptic was Harry Markopolos, a financial analyst who, in the late 1990s, tried to replicate Madoff's strategy. Within hours, Markopolos realized the reported returns were mathematically impossible. He warned the SEC multiple times, labeling Madoff's entire operation a likely fraud or an illegal front-running scheme. Yet regulators barely took notice. Madoff's reputation as a former Nasdaq chairman and industry philanthropist overshadowed the glaring inconsistencies that Markopolos laid out in detailed memos.
Harry Markopolos comes in 2005 with this very long document with nearly 30 red flags. What Harry basically came forward with was the trading strategy that Bernie Madoff had stated he used was just not something that could achieve those kinds of returns. And he said, look at the numbers, look at what he provided. It's impossible that he's trading in the volume that he says he is.
Many simply assumed that if such a prominent figure were really a fraud, it would have already been caught. No one wanted to probe too deeply into something that seemed to mint reliable profits year after year. Chapter 4: The 2008 Financial Crisis, the domino that toppled the tower. Bernie's scheme might have continued even longer had it not been for the 2008 financial crisis. As markets crashed, Madoff's clients demanded massive withdrawals to cover losses from other areas. When investors tried to pull out $7 billion, Bernie needed new money to replace it. With the economy in free fall, the usual pipeline of new investors dried up. In December 2008, Madoff confessed to his sons that his wealth management arm was a big lie. The next day, the FBI arrested him, and the colossal illusion dissolved almost overnight.
Bernie Madoff has been arrested. He's the founder of Bernie Madoff Investment Securities. He's 70 years old. He is a fixture on Wall Street. Bernie Madoff, 70 years old, arrested by the FBI.
This former iconic figure on Wall Street has allegedly, but by his own admission, destroyed many lives, charities, and reputations on Wall Street and around the world. A walk of shame and shoving.
What seemed untouchable and genius was revealed to be a decades-long sham, crushing thousands of livelihoods in its wake. Chapter 5: The Reckoning. Madoff pleaded guilty to 11 federal crimes, from securities fraud to money laundering. Although $65 billion was the figure on client statements, the actual principal lost was closer to $20 billion. Nonetheless, thousands of investors, including charities and retirees, were financially devastated. Many saw their entire life savings wiped out overnight.
It's one thing to lose your life savings, but when you lose your house too, it's terrible.
The court handed down a sentence of 150 years, the maximum allowable, plus $170 billion in restitution. Even then, the punishment felt symbolic for those who had lost their futures. Tragedy compounded when Madoff's son, Mark, died by suicide exactly 2 years after his father's arrest. Charitable foundations folded, trust funds collapsed, and countless families found themselves back at square one. Chapter 6: Aftermath and Continuing Fallout. Though Bernie Madoff died in prison in 2021, the ripples of his fraud continue to this day. Court-appointed trustees have recovered billions and returned significant portions of investors' principal, but many victims will never be made whole. The SEC, embarrassed by how many times it overlooked red flags, underwent internal reviews to reform its investigative processes.
The Dow down nearly 450 points.
We just hit 730 or something. We've never seen that.
Traders in Tokyo worried about a spreading U.S. recession.
Chapter 7: Lessons Learned. Bernie Madoff's story offers a stark lesson. Sometimes exclusivity and big names can lull investors into handing over due diligence to the so-called experts. The saga also highlights the psychological lure of steady returns, which can blind even the savviest individuals to blatant red flags. It reveals that regulatory systems, for all their checks, can still fall asleep at the wheel. When the allure of an easy and predictable profit meets our reluctance to question affable, well-connected leaders, the results can be ruinous. Madoff's downfall underscores a timeless truth in finance. If it looks too good to be true, it almost certainly is. Bernie Madoff's multi-decade Ponzi scheme was the largest in history, a deception so vast it shook the finance world to its core. From his cultivated image of exclusivity to his understated but constant returns, he fashioned a story everyone wanted to believe. Yet illusions inevitably crumble, especially when market turmoil forces a real accounting of where the money is and isn't. Thank you for watching. If you found this exploration helpful or thought-provoking, remember to like, share, and subscribe. Let's keep learning from these cautionary tales so we don't stumble into the same traps tomorrow.